We're tracking on this Friday morning. So happy Friday to all of you and good morning in the Mumbai News Center. I'm Sonal Bhutra and you're watching Power Breakfast. But first up, as always, let's take a look at what the Asian markets are doing, largely in the red today ahead of the US jobs report, which will guide the Fed's monetary decision in November. Hang Seng is the one which is sitting with cuts of 1%. We have Taiwanese index, which is down 0.9%. Nikkei 2 is down in the red, deep in the red, 0.5% lower there. Across the board, there's a lot of selling after that weak handover that came in from the US markets. SGX Nifty, as a result of which, is indicating that the start for our own markets, well, that could be in the red. A 40-point downtick is what this particular index is suggesting. In the US markets, key indices ended lower for the second straight session, with the Dow Jones sliding over 340 points, the S&P 500 about 1% lower, and the Nasdaq Composite closing 75 points lower. CNBC's Bertha Coombs gets a wrap of all the action on Wall Street.
A second straight day of losses for the market, eating into what had been a strong start to the week. Investors are awaiting the key September jobs report due out tomorrow. The Dow ending down just over 1%, the S&P falling about 1% as well. The Nasdaq just a little better, down about 0.75%. A new data from Edmunds shows that a growing share of car buyers here in the U.S. are signing up for monthly loan payments of $1,000 or more. Over 14% of consumers who financed a new vehicle are paying above $1,000 now, which is nearly double the rate from a year ago. Experts say these inflated payments are due to rising interest rates and lagging vehicle inventory. Meantime, real estate was one of the biggest sector losers today, coming amid a report of slowing apartment demand from RealPage. The rental technology company says this was the first third-quarter drop in the 3 decades that they've been tracking that data. Higher rent prices and lower consumer confidence have contributed to slowing demand. That's the action from the U.S. market. Now back over to you in Mumbai.
Okay, ahead of the September jobs report due to be released later today, a key cue for investors. Let us also listen into some important opinion coming in from Andrew Sliman of Morgan Stanley Investment Management, our Wharton School's Jeremy Siegel, and former Kansas City Fed President Thomas Hoeing. Listen in.
I think tomorrow's number is going to be strong enough to reinforce at this juncture that the Fed's going to remain tough. Now we have a CPI number coming up. And I do think there's been a lag in these numbers. I do think those numbers will come down. So we might get some relief next week. But I think the jobs number tomorrow is only going to further strengthen the argument the Fed will remain, tight and hawkish.
They should have started tightening much earlier. But now I fear that they're slamming on the brakes way too hard. And if they stay as tight as they say they will, continuing to hike rates through even the early part of next year, the risk of recession are extremely high.
They need to stay there and not back off of that too soon to where they reignite inflation, say, in the second quarter of 2023 or the third quarter. So they have a very delicate and very difficult period ahead of them in terms of decision making. But I think to pause at 3% may be too soon and too low.
Okay, that is all about what is expected from Fed and the general US market update as well. But let us get you the final update on our global market wrap. European markets also ended Thursday's trading session lower, with the French CAC 49 points lower, the German DAX down 46, and the British FTSE closing with cuts of 55 points. Market in Europe were under pressure after the Eurozone PMI fell to a 20-month low, fueling recession fears in the region. Shares of energy giant